On behalf of His Majesty's Government, the nation, and our public financial management community, it is with great anticipation and excitement that I extend a heartfelt invitation to you, the esteemed Accountant Generals of Africa and distinguished delegates, to join us in our beautiful kingdom of Eswatini this coming December 2026 for the 4th AG Conference. We are eager to welcome you to our shores and share with you the unique warmth of our nation. Not only the welcoming climate of our sun-kissed days, but also the genuine hospitality of Emaswati. We look forward to offering you the chance to experience our rich cultural heritage and stunning landscape, ensuring your visit is both memorable and enriching. We have no doubt that the calm and vibrant atmosphere of Eswatini in December will provide the perfect backdrop of our crucial discussions on the future of our public financial management in Africa. This gathering will be a pivotal opportunity to strengthen our collective resolve, share groundbreaking insights, and chart a collaborative course toward greater transparency and prosperity for our continent. We are busy preparing a productive agenda and a wonderfully engaging experience for you all, and cannot wait to say nemukelekile in person. Siyabonga kakhulu. We thank you very much.
Good morning, good afternoon, good evening, depending on which side of the world, the continent you are joining us from. We want to welcome you to this webinar on reporting for resilience, strengthening public sector sustainability reporting under IPSASB SRS 1. Allow me, firstly, distinguished participants, allow me to recognize the presence of all dignitaries who are present with us on this webinar. Accountant Generals present. We have the presence of the Accountant General from the Kingdom of Lesotho. Madam Eji, you are welcome. And all other Accountants Generals that we may not have yet observed, you're welcome. Distinguished Accountant Generals, deputies, senior public financial management officials who are present here. We've noted there could be representative of Ministries of Finance, Supreme Audit Institution, development partners, any professional accountants organization present, colleagues from the standard setters, our invited speakers, colleagues, ladies and gentlemen. It's a good afternoon from us at Triple AG. It is my pleasure on behalf of the African Association of Accountants General to welcome you to this important webinar. We are honored that you spared time to participate and be with us on this webinar. This is your participation is appreciated as it shows commitment for you, our members, partners, in advancing public sector financial reporting across Africa. The topic that we are discussing today is very important and very key in the sense that across our continent, governments are facing the increasing effects of climate-related risk through damaged infrastructure, disrupted service delivery, rising emergency expenditures, weakened budget credibility, and pressure on public debts. All these threaten long-term development outcomes. These risks have direct implication on how we manage our public finances, and therefore, ladies and gentlemen, they must be reflected in the way governments plan, how governments manage resources, report, and account for such public resources. We're excited that in December last year, the International Public Sector Accounting Standards Board, IPSASB, issued the standard on sustainability, reporting standard number 1 on climate-related disclosure, which is a very significant step in how public sector manages risk related to climate issues. I think the presenter will go into details around this standard, but ladies and gentlemen, allow me to state that at the center of the IPSASB Sustainability Reporting Standard number 1, there are 4 pillars that have been identified around governance, strategy, risk management, metrics, and targets. These pillars require public sectors to explain how climate-related matters are overseen and how they influence strategic decision. For us in Africa, and possibly others that may be joining us from other continents, this agenda is very important. Many of our countries are highly exposed to climate risk, yet the public sector reporting system do not provide sufficient information on the impact of these risks on the public assets, the service, the infrastructure, the debt, and physical resilience. Therefore, it requires that strengthening sustainability reporting would help close this gap, support better policy choices, and improve stakeholder confidence and enhance accountability to citizens. The role of the Office of the Accountant General then becomes central to this journey. As custodians of public financial reporting systems, the offices of the Accountant General are well placed to coordinate climate-related financial information, to strengthen data integrity, and connect sustainability disclosures to financial statements. They would also support integration with the wider public financial management reform. Therefore, this requires close collaborations with various stakeholders, including the ministries of finance, planning authorities, climate-related agencies, the physical risk and debt units, as well as a supreme audit institution. At IPSASB, we see this webinar as not only about understanding and discussing the new standard. For us, we are looking at how best do we prepare our institutions for implementation. It then calls for us to start and begin to ask critical questions. For example, what related risks are material to our governments? What data do we already have on climate-related risk? Where are the gaps? And how do we connect disclosures, how do we connect sustainability disclosures to financial statements, to our budgets, to our physical risks, as well as service delivery? These are very important. Ladies and gentlemen, to help us delve into this discussion, allow me then to bring in the presenters who would be able to speak to some of these vexing questions that we have. We've got colleagues from the International Public Sector Accounting Standards Board, where we are joined by Celine Chan. Celine is the principal at the International Public Sector Accounting Standards Board. Since joining the IPSASB staff in 2022, Celine supported sustainability reporting technical project, strategic initiatives to deliver IPSASB work program and is currently leading the climate-related disclosure standard project. Prior to joining the IPSASB, Celine was an AVP in accounting, policy, and advisory at TD Bank, where she led the team in advising on transactions, the business, and intangible valuation, as well as retail banking under the IFRS and the US GAAP. Celine started her accounting journey at Deloitte in Canada in the assurance practice, specializing in financial institutions, primarily based in Toronto, Canada, as well as secondment in North Carolina, of the United States, and volunteer position in Tanzania. She has also served as a board member of the Homeless Connect Toronto, a registered Canadian charity that engages the local community and builds partnership to contribute to solutions for overcoming homelessness in the city. Celine is a chartered accountant and holds a Bachelor of International Business Administration from York University in Toronto. Ladies and gentlemen, allow me to bring in Celine to share with us the details on this webinar and the important topic that we are discussing on reporting for resilience, strengthening public sector sustainability reporting under IPSASB SRS 1. Celine, it's a pleasure to have you. Celine, your mic is mute, Celine.
Yes. Thank you. Good day. Thank you very much, Bruce, for that introduction. I am very excited to be here and to share with you about our inaugural standard. I want to say I love your title for this webinar today, Reporting for Resilience. That really is the heart and the aim of this standard and the IPSASB's work to really do reporting not just for the sake of reporting, but to inform those decisions and help build our public sectors to be ready for the climate risks and the opportunities that are out there. So let me share my slides and I'll get into our presentation. So today I will be providing a background for you on the new standard and walk through those disclosure requirements. I'd like to highlight, how the standard informs our PFM cycle to really drive home the connection and the importance of the disclosures, not just for reporting, but really to drive our decisions. And finally, at the end, I will give an update sort of on the next steps and what to look forward to from the IPSASB. So for those of you who may not be so familiar with who are we? We are the International Public Sector Accounting Standards Board. So we set the standards for financial and now sustainability reporting. We have an international board of 18 members from around the world, 18 public sector finance experts with from different regions and different functional backgrounds. We're funded also by the International Federation of Accountants and other international organizations and sovereign governments, including the World Bank, who is our primary funder for our climate-related disclosures project. We operate under a robust and inclusive due process. We have an oversight committee, the Public Interest Committee, which includes the World Bank, IMF, OECD, and INTOSAI. And they oversee and ensure that the work that the board does is in the public interest. The board also has a consultative advisory group, so it provides advice as we develop standards. And you'll see here at the bottom, the work program, we work on financial reporting, now it's still sustainability reporting. As many of you may know, we have IPSAS, the International Public Sector Accounting Standards. We have 39 standards now, and they are really aimed at providing better information for public sector financial management and decision making. They are aligned with the International Financial Reporting Standards, the IFRS, issued by the International Accounting Standards Board, and the IPSASB aims to align them and just identify where there's public sector specific issues that warrant departures from the IASB documents. So we have historically always valued the private sector guidance and recognize that where the transactions are the same, we would provide similar disclosures and similar requirements as for the public sector, but identifying where those public sector specific issues really lie and where there's additional requirements or guidance needed for financial reporting. And we've also now added the sustainability reporting. So this is, I'll give you a bit of background on our journey there, but just to clarify upfront that the financial reporting and sustainability reporting standards are independent suites of standards. So that means that if an entity is applying IPSAS, they're not required automatically to apply the sustainability reporting standards, the IPSASB SRS, and vice versa. If you choose to adopt the IPSASB SRS, the Sustainability Reporting Standards, you're not required to apply the full suite of IPSAS either, or any really other other framework. So with that bit of a background, I'll give you a overview of our journey first into sustainability reporting. So our journey officially began in January 2022 when the World Bank issued a report calling on the IPSASB to lead a consultation on who should develop public sector standards for sustainability. So at that point, there was no international standard for sustainability. And so the World Bank identified the IPSASB given our history and our experience in setting standards for the public sector. And so that was followed by the IPSASB's consultation paper in May 2022. And what we heard back from that was that, yes, IPSASB is the right organization to lead the development of public sector sustainability reporting standards, given our expertise in public sector and our established governance and oversight processes and robust due process. And they said that, yes, we should build on private sector guidance. So similar to our approach for financial reporting, we build off the private sector guidance and adapt it for the public sector, because the public sector does have differences from the private sector. And so that led us to our ED, our exposure draft, which was published in 2024. And that was out for comment until 2025, and by the end of 2025 we finalized and approved our first IPSASB SRS standard. So this standard is focused on climate. What we heard from constituents to the consultation was agreement that climate is the first priority, and so that is what our first SRS was on, and definitely stay tuned for other topics and other next projects. But my next slide is on the why, the need for sustainability reporting, and I think Bruce really touched on this. Bruce had some great points and really why we really need to focus and why this is important. There's a number of factors, just a few listed here. The first one is, as we all know, climate risks have real fiscal consequences. Research by the OECD in 2025 showed that severe weather events on average reduced regional GDP by 2.2%. The losses from these persist for years, and spillover effects compound the impact. These shocks result in real impacts on government's tax revenues, emergency expenditures, economic growth. And so really these climate disclosures will hopefully help governments and investors assess the risks and build resilience. Secondly, delivering user-centric reporting. The IPSASB built on ISSB standards, leveraging global best practice, And they're designed to inform user needs. So it's really focused on users and how we can provide the right information for whether it's investors, citizens, oversight bodies, ensuring consistency and comparability across sectors, across public-private sectors, and enhancing public sector information. And thirdly, investor-focused transparency. We know that bondholders, sovereign bonds make up about 40% of the global bond market. And so there is a demand for this information from investors. And then providing this reliable climate-related information will give them the information to assess climate risks, price debt, and make informed capital allocation decisions. This can also contribute to market efficiency and potentially lower borrowing costs for governments. And finally, resilience. Really, I love this reporting for resilience. Resilience through disclosure. We can improve decision-making and accountability through providing integrated climate disclosures that will inform our fiscal planning, risk management, and long-term policy responses. So that led us really to develop this IPSASB SRS1, our inaugural standard. It is designed specifically for reporting on climate-related risks and opportunities. So that's from the entity's day-to-day activities and operations. What are the climate-related risks and opportunities affecting you? And that was published at the beginning of this year, effective for reporting periods starting on or after January 1st, 2028. This is a significant milestone as it creates a standard for the public sector, the first internationally to support governments and public sector entities to provide that high quality, decision useful climate related information. So the objective and scope, just to highlight that for you, is to disclose material information about climate-related risks and opportunities that could reasonably be expected to affect the long-term fiscal sustainability of an entity. So we talk about long-term fiscal sustainability. If you're familiar with the IFRS S2, they talk about an entity's prospects. But in the public sector, the focus is really on long-term fiscal sustainability, which is an entity's ability to meet service delivery and financial commitments, both now and in the future. That includes your service commitments, whether you're running public schools, hospitals, and other, building infrastructure. The question really from these disclosures is how resilient is the entity to continue providing these services in light of the climate-related risks that are happening. So that's really what all of these disclosures are driving at and helps the entity understand and recognize what all the different issues could be. For example, an entity is an area of high risk for sea level rise. You disclose how it oversees, how you respond, manage, and monitor the risks of sea level rise. And so that's the type of disclosures that this standard is really aimed at. As Bruce mentioned, we do have these 4 pillars. This slide just gives you an overview of our standard because there are a number of components to it. We have our core text, application guidance, and then we have a number of appendices. So in our core text and application guidance, we have those 4 pillars of disclosure, and that's really built on the private sector guidance. Governance, strategy, risk management, metrics, and targets is aligned with the TCFD framework, which the IFRS S2 is built on. And so I'll get into more details about this, about these pillars and what the disclosure requirements are for those shortly. And then we also have the appendices, which cover the conceptual foundations, general requirements, qualitative characteristics. So these come from I guess when you're building a new suite of standards, we don't yet have a conceptual framework, given we want it to produce these in haste, and there's an urgency for these. We have included these general requirements and conceptual foundations in our appendix. And these are also aligned with the private sector. These are aligned with parts of IFRS S1, tailored again for the public sector, but they cover our base general requirements like the timing of frequency of reporting, where to report. They cover materiality and fair presentation, which we'll touch on again in this presentation. So just on the comparison with the private sector, as we said, we built on the private sector guidance, but there are key differences for the public sector. So if you're familiar with the IFRS S2, these are the key differences between IFRS S2 and IPSASB SRS 1. So the key really is, first of all, who are our users, who are these disclosures for? The IFRS S2 is primarily designed to meet information needs of investors. They have a very laser focus on investors, and they use terminology and disclosure approaches aligned for the public sector. So the IPSASB SRS 1 in comparison has a different definition of primary users. Aligned with our financial reporting, primary users of sustainability reporting are service recipients and resource providers for the public sector. So that's a broader audience. That includes, service recipients like our citizens, and resource providers, including taxpayers, definitely includes bondholders and other organizations that do provide funding to the government. And so that's a broader stakeholder base than investors, which leads to a broader assessment really of the information, what's material for disclosure. Secondly, there's also public sector terminology adaptations. So as I mentioned, the IFRS S2 talks about an entity's prospects, so the value for investors in a company. But for the public sector, we really focus on long-term fiscal sustainability. So that's one of the key terminology differences. There's also terminology changes from, say, your business model in IFRS S2 to operational model for our IPSASB SRS 1. And finally, the third key difference is on GHG protocol. So for reporting emissions, IFRS S2 mandates the use of GHG protocol. So from the private sector, that's really, that is a private sector designed standard. And it does meant to provide consistency across private sector entities for investor decisions. But from the public sector, the board decided to provide a rebuttable presumption. So you may use the GHG protocol unless the entity has another established method that's more appropriate for its context. So the board acknowledged that there may be jurisdictions where you have an established methodology, places where they already are doing their emissions calculations in a scientific method. And so you may continue to use that, but for otherwise, the board would recommend, using the GHG protocol. So those are the key difference. There's some other differences I'll highlight as we go. And so let's dive into the standard. And so this is, again, an overview of the objectives, the climate-related risks and opportunities. This is the focus. And what I'll highlight here is that this standard is meant to include all public sector activities. So it includes all the operations of an entity. It includes, service delivery, as well as policy design, implementation. This standard can be applied for all public sector entities. And we'll go into each of these pillars, and I'll dive into each of these now. So to start off, governance. This is our first pillar. The governance disclosures focus on oversight of climate-related risks and opportunities. So what are the governance processes, controls, and procedures that the entity uses to monitor, manage, and oversee climate-related risks and opportunities? So this includes information about the governing body itself. Who is the governing body that oversees climate-related risks and opportunities? This could be, in public sectors, this could be on a board, a committee, it could be in your for your entity specifically, or oversight for a group of entities. And who is it? And then you also disclose what are their skills and competencies, so users can understand, are they competent to oversee? Do they have knowledge about climate-related risks and opportunities? And what's the frequency that they're informed on climate-related risks and opportunities? Is it quarterly? Is it once a year, annually? How often are they overseeing and monitoring the climate-related risks and opportunities? And then secondly, what is the role of management? What is management's role in governance over the climate-related risks and opportunities that the entity identifies? So this is a narrative disclosure to help entities understand, but critical to have those established up front as we start our climate-related disclosures journey to identify the governing bodies and set up those reporting to our governing bodies. The next pillar is on strategy. So there are a lot of disclosures here on strategy, and these are really driving at that reporting for resilience. The disclosures tell what's the entity's strategy, what is your plan to respond to climate-related risks and opportunities. What is the entity's plan to address these climate-related risks and achieve any targets it has set? So that includes, first identifying and disclosing. Tell us what are the climate-related risks and opportunities that have been identified. What are those climate-related, for example, physical risks? Are you exposed to, storms, rising sea levels, flooding, increasing temperatures, drought? What are those risks that affect the entity's long-term fiscal sustainability? And what are the time horizons? When are they expected to affect your operational model and even your value chain? When we talk about value chain, it's thinking about the upstream and downstream, where you procure any resources from, how are your suppliers affected, or downstream, like your citizens, how are they affected? And how will that affect your entity's long-term fiscal sustainability? There could be opportunities too, not just risks, such as technology, new technologies that the entity may look at investing in, and what is your long-term plans for that? So once you've identified what those climate-related risks and opportunities are, then how is the entity planning to respond? So that's second row. How entity responds to climate-related risks and opportunities. And what are your actions? What are your plans to integrate that into your strategy? And thirdly, financial position, performance, and cash flows really ties back to your financial planning and to linking the sustainability information to your financial reporting. So there's a component that is about your current effects on your financial statements. So what currently are there any effects that you may think about, such as are there any impaired assets or abandoned assets on your balance sheet that are affected as a result of climate-related risks in the current reporting period? And if I look out to my financial planning, Have you considered how the climate-related risks and opportunities affect your future financial planning, your financial budget, your projections over the short, medium, and long term? It could be, for example, investing in new technologies, investing in new infrastructure. What are the capital needs there? What does disaster recovery look like in the future? How do you plan for that? And finally, climate resilience. So climate resilience is, you may have heard climate-related scenario analysis. So this is really modeling. What type of modeling have you done to inform your strategy and decision-making? Have you looked at different scenarios, low, intermediate, high emissions scenarios, to inform and assess what is the likelihood of different scenarios and how that affects your strategy? All right, the next pillar is risk management. So risk management is, again, narrative disclosure. It talks about your risk management processes. What are those risk management processes you have to help identify, assess, prioritize, and monitor your climate-related risks and opportunities? How are they integrated with your entity's overall risk management process? So what kind of information do you have? This includes, what are your data sources, inputs into your risk management process? Do you use climate-related scenario analysis to help you identify risks? And the extent to which these are, again, integrated with your overall risk management process. So really bringing in climate-related risk assessments into looking at your overall risk that the entity faces. And it's not in silos, but it's a part of the overall strategy and processes that the organization has. And the final pillar is metrics and targets. So this is really about measuring your performance, and if you have targets, your progress towards those targets. And so the disclosures require disclosing a number of different targets. The first, and probably the most significant one, is on your emissions. So as I mentioned earlier, the IPSASB SRS one refers to the greenhouse gas protocol, but there is a rebuttable presumption. So when you're disclosing your scope 1, 2, 3 greenhouse gas emissions, you may look to the greenhouse gas protocol if you don't have another established methodology. But if you do, you may continue to use that established methodology. And there is a 3-year transition period. So the board recognized how significant this is, how significant of an effort it will be, and how it will be a steep learning curve for a lot of organizations. So there's 3 years from adopting and applying the standard. You have 3 years to actually start reporting. So start preparing and reporting these greenhouse gas emissions. The other metrics that are required by the standard include disclosures about your climate-related transition risks, your physical risks, and opportunities. So this could be, the amount of operating activities or assets that could be affected by transition or physical risks. It could be a percentage of total assets, for example, that you're potentially at risk of impairment. There's infrastructure, for example, that's at risk of impairment. And so what's the percent of that of your total assets, or opportunities, how much investment there could potentially be you'd be looking at. Similar tied to that, capital deployment. What is the amount of investment needs to be deployed to address climate-related risks and opportunities? Internal carbon price is another. So if the entity uses internal carbon price for decision making, what is that? Or if not, you disclose that. Remuneration. This is one that the board included. It is from the IFRS S2, but recognizing this may not be that common in the public sector. It is about disclosing whether climate-related considerations are directly factored into remuneration of key management personnel. So that may not be that common in the public sector, but to the extent it is applicable for your entity, they would require those disclosures. And finally, peer metrics. So peer metrics is also an adaptation from the S2. S2 talks about industry-based metrics. So industry-based metrics, they have a separate standard that they've brought in from the IPSASB, and so they have an established list of metrics. But for the public sector, we think that this would look more like entities can learn from their peers, look across at entities with similar functions or in similar geographies that would be providing fairly standard peer metrics. So that is really up to the entity to look and see what else, other disclosures, what other metrics would be useful for them really in assessing their climate resilience. So these are all tied to your targets too. So you have targets you may set to monitor, and you will report on your progress towards achieving those strategic goals. Now on materiality. This is one of those key overarching concepts that is really important to clarify and understand, and really is the lens that entities should think about when they're reporting and determining what to report and disclose on for climate-related risks and opportunities. So if you're familiar in the sustainability world, there's a number of different terms for materiality. There's things like financial materiality, impact materiality, double materiality. And so the IPSASB really had to think hard on what's the right concept for the public sector. And so it landed on aligning with the conceptual framework that the IPSASB already has established. And so the key concepts here are focusing on the primary users. Who is your primary user? And that, as I said, is service recipients and resource providers in the public sector context, and what information is material to them. What information, if you omit it, misstate it, or obscure it, could influence the decision-making of that user or the discharge of accountability by the entity. So those two key objectives around decision-making, accountability are coming from our conceptual framework, are aligned with that same importance of not just decision-making, but accountability for the public sector. And finally, bring that into looking at the general purpose financial reports prepared in that reporting. That brings in the connectivity between our financial reporting and sustainability reporting. So I think the bottom line on materiality is really about focusing on information and the information needs of primary users, and it will ultimately require professional judgment. It will be highly specific to each entity, and so judgment will be required, but it's really driven by those primary users. So the other key elements here from the general requirements include fair presentation. So that is providing complete neutral information free from material error. It should be it should be neutral, not one-sided, not necessarily only highlighting the great opportunities, but you need to balance it and have a very neutral, complete perspective on your climate-related risks and opportunities. The reporting should be at the is part of the financial statements. So for the same reporting entity as the financial statements, it should be disclosed along with those general purpose financial reports and at the same time. And finally, it should be looking at the connectivity. It should be the information for sustainability reporting should really be tied to and aligned with your financial statements. So as we talked about earlier, if you identify climate-related risks that impact your current period statements, that should really be speaking across, and climate-related information is not going to be useful. You're not going to build resilience if it's in a silo, but it needs to be connected between and across different disclosures and across the entities work. So to summarize the detailed requirements, this is really a key summary. It's really driven about providing information to the primary users, those service recipients and resource providers, for making decisions and holding entities accountable. The climate-related, it's talking about climate-related risks and opportunities to the entity to really help build that resilience, and it also discloses your GHG emissions and all of your climate action, the work you're doing to help mitigate and adapt to climate risks. For those looking at the adopting, we do have transition. So as mentioned, this standard will be is effective for reporting periods on or after January 1st, 2028. In the first annual period, you do not need to include comparative information, and it does not have to be at the same time as reported as your financial statements. So there is some timing considerations there. And as mentioned, in the first 3 periods, you do not have to disclose your Scope 3 greenhouse gas emissions. So I'm conscious of the time. I do want to talk through the key benefits of this from a PFM perspective. So there is, the left side of this slide shows the PFM cycle, which starts with strategy and planning, including budget preparation, then continues with budget execution and performance monitoring, and then entities move on to external reporting and ultimately external audit and oversight, leading back into strategic strategy and planning. So under strategy and planning, this standard requires entities to undertake climate scenario analysis. That can help to improve your understanding of your operating model and your resilience to climate and shocks. So this information will really aim to help lead more informed allocation of public investment and increasing your resilience. So informing that decision making. From a budget execution perspective, budget execution and performance management, the information on climate-related risks and opportunities should help entities with, for example, treasury management. How do you manage the scarce resources that the public sectors have? So it'll help increase the efficiency and use of resources in the public sector. From stakeholder reporting, this external reporting, the SRS will really help different stakeholders across the PFM ecosystem to effectively hold public sector entities to account for the outcomes that they work and their mandates in the public sector. And finally, in terms of audit and oversight, the sustainability reporting standards support size in providing robust and effective assurance on these disclosures, and ultimately lead to increased public trust in the public sector as we make progress on our climate commitments. And so just briefly on next steps, some things to highlight. We have approved the first SRS-1 climate-related disclosures. We are looking at developing implementation material. So through this year, we're working on implementation material. We'd like to invite any folks interested in our Sustainability Implementation Forum. This is a group that is looking to help provide practical feedback based on the first SRS-1. They provide input, and it's a forum for folks. There are some implementation leaders, folks who are advanced already in public sector sustainability reporting, and it's a sharing of experience and looking at really how do we practically start to adopt and apply and implement SRS1. So this, we do have a number of entities from around the world that are part of this SIF, and so we do welcome any others who are interested. Don't hesitate to reach out if you'd like to join this forum to hear about what's going on around the world and to really participate and be part of building out that implementation guidance and becoming an implementation leader on sustainability reporting. We are also working on a second phase of the standard. So I didn't touch on this yet, but in the exposure draft covered two prongs of the role of government. The first was SRS1. So what are the entity's own operations? So as a government, you do have your day-to-day activities and what are the climate-related risks and opportunities that affect those day-to-day activities and your sustainability. And our phase 2 is now looking at those public policy outcomes. What is the public policy role? So as we all know, the general government, as you see in this diagram, has influence on the actions and behaviors of all sectors of the economy, public corporations, private corporations, households, and nonprofits. So the government can regulate, the government can introduce taxes, the government can create new policies that influence the behaviors. And so that's an important role that we heard from stakeholders that said we need to have just standardized disclosures to address these and provide accountability to the policies that are set. So this is a second phase that we are working on now, and we hope to have published within the next year. And that will not be for all entities, but for those who really set public policy. So look forward to that. Stay tuned for that second phase and that second standard coming out. So with that, Bruce, I hope I'm okay for time. Thank you very much for your interest in the standard and for your time and being here with me today.
Thank you very much, Celine, for that insightful presentation. And indeed, quite a lot has come out. Particularly, I've picked on a couple of things. Number one, on the need to integrate climate-related risks and opportunities to the overall risk management of the entity or the organization, and not just working in silos, as you had put it. And more importantly, Serene, I've picked the importance of sustainability reporting to revolve around the whole PFM cycle, so that we do not leave any area untouched. And I think you brought up quite key important issues that we've picked as food for thought. For me, I also really took on board the need to deploy capital to address climate-related risks, so that particularly for us in Africa, you have risk affecting your road infrastructure and the like, your key infrastructure. So the need to deploy infrastructure that will be resilient to these risks is very important. And obviously, Celine, we look forward to the next project, but hang on, we will later on bring the participants to come and seek clarification as we go further with this discussion. Allow me to move on then and bring in another presenter. But before I do that, ladies and gentlemen, for those Portuguese-speaking, French-speaking, and others that have joined in from different languages, we've deployed our Wedly. Kindly join in and have your translation. You could either listen in or follow through the transcript that the translation platform would be able to guide. Our next presenter, ladies and gentlemen, will discuss from the perspective of the country, from Nigeria, how the country is addressing this topic. Allow me to bring in Dr. Abubakar Razak, who is currently the head of sustainability reporting regulations at the Financial Reporting Council of Nigeria. Dr. Razak holds a PhD in accounting from Nasarawa State University. He is a fellow of the Institute of Chartered Accountants of Nigeria, as well as a fellow of the Institute of Chartered Secretaries and Administrators of Nigeria. Prior to joining the Financial Reporting Council of Nigeria, Dr. Razak has had the diverse work experience in the financial reporting services industry, private and public sector economies, which spanned post-qualification period of 15 years with reputable companies, including the FCM Bank PLC, Sterling Bank PLC, Nigeria Merchant Plans Development Company, and Adeshina Yewuswa, which is a chartered accounting firm. From his experience, he carved a niche for himself in financial reporting, audit and assurance, regulatory compliance, and sustainability reporting. Ladies and gentlemen, kindly allow me to welcome in Dr. Razak to share the country experience from Nigeria. Doc, over to you.
Good day, everyone. Hi to you. It has been very exciting. I'm excited to be here on this program, talking to sustainability reporting at this level. Let me commend the IPSASB for this program, which is very been enlightening from the beginning. Thank you, Celine, for that wonderful insight you have shared from IPSASB point of view. And it's important that we note that at Financial Reporting Council of Nigeria, we actually appreciate this kind of move, which resonates favorably with what we are doing at Financial Reporting Council of Nigeria to cascade information to promote sustainability reporting, not just in the private sector of the economy and also for the public sector. And I thank you for inviting us for this program. The CEO, Dr. Rabi Olu of Financial Reporting Council of Nigeria, is actually interested in this program and commends the organizer of this program for this kind of wonderful, put together to have knowledge on sustainability reporting. Okay, I'm currently sharing my screen now. I don't know whether I can confirm that you have seen it.
Yes, we can see it.
Okay, thank you very much. It is my pleasure to speak to Reporting for Resilience, Strengthening Public Sector Sustainability Reporting under International Public Sector Accounting Standard Board SRS 1, which is a climate-related disclosure. Just like it has been said, I'm the head of Sustainability Reporting Regulations in the Financial Reporting Council of Nigeria, also the secretary of the Adoption Readiness Working Group for Sustainability Reporting in Nigeria, ARWG. That is the group that work on the platform and roadmap for Nigerian sustainability reporting. I'm also a member of the Sustainability Implementation Forum of IPSASB. Speaking to the Reporting for Resilience on sustainability for public sector, we are talking about a way the public sector entity, different from public sector with certain characteristics, can actually navigate the climate-related risk in all its ramifications, be it in the public financial management cycle or the intervening in the budgetary expenditure, and also maintaining the climate aspect in the manner that is favorable to the country. It's a framework for transparent, accountable climate disclosure across the public sector of the entity. You will recall that sustainability reporting becomes very prominent in the 1987 when Gro Harlem Brundtland, the former Norwegian Prime Minister, headed the committee known as Work Commission on Environment and Development. And it is this committee that first worked on the issue of sustainability reporting. And it was this committee that defined sustainability as development that meets the needs of the present generation without compromising the ability of future generations to meet their own need. This means sustainability reporting is something that is about resource management, about resource conservation, not just for this generation, but for different generations to come. So when we're talking about sustainability today, we are talking about resource control, not just for this present generation, but for the different generations to come. But when we talk about sustainability in terms of financial reporting, we are talking about non-financial information published by organization, either private or public, which reflects mainly its performance in terms of three major criteria, in terms of environment, social, and governance dimensions of the operations, and how these criteria has actually worked together in the everyday life of an organization. So when we look at sustainability reporting from this angle, in public sector, what are the reasons, what are the drivers of sustainability reporting? From 1987, and from the recommendation of a Broadland report, which has a feature in our common future, we have seen that climate risk has been in the forefront of the issue of sustainability reporting when it comes to the public sector. We have seen the high rise of water and global warming, which has affected the global warming, and also having effect on our environment in the flood and the rise in temperature has also become an issue for government to manage. Then we talk about evolution of risk and opportunity. Opportunities are there, bringing in the climate risk issue. Also, there are also challenges. Investors and common stakeholders are now realizing that there's a need for us to balance the risks and opportunities when it comes to sustainability reporting. Stakeholder pressure is always there, demanding for company, either private or public, to account of how they have used the environment and the investors' expectations. Investors now, either international lenders, creditors, they want to know how a country is faring in terms of how they manage sustainability risks and opportunity. And we are now seeing, regulatory evolution, where regulators like Financial Reporting Council of Nigeria are now demanding for sustainability reporting to be part and parcel of a financial reporting. From what we have seen, as we are going to see now from our Nigerian roadmap, you cannot prepare sustainability financial reporting alone. Your financial reporting cannot be complete without having sustainability reporting as part of it from our roadmap. So regulators now, more than ever before, want to see how companies, entities, be it private and public, account for their environment, social, and governance dimensions in their day-to-day operations. And why does it matter to us? Why should the climate matter to us? We see infrastructure damage, where escalating extreme weather are causing widespread disruption to our roads in terms of rain drainage, utilities, and disruption of critical public services. And the government has to now spend money, which has to be budgeted for. And there could be constraint, in this direction. If the government is not buoyant enough to do it, could lead to service disruption and a lot of complaint and unrest from the citizenry. So government needs to manage the infrastructure damage. What of migration and liability? Climate-induced displacement, due to war and other things, is actually causing and rising insurance costs, which is strain to public sector budget in terms of budgeting and financing. The fiscal imbalance, long-term fiscal risk due to climate risk could threaten the public service or public goods in terms of sustainability of essential public service, climate relief and future generations. So the issue of climate is central to the governance of a public sector because it's more than private sector. They have responsibility to be accountable for the refuse dump, the environmental cleaning, fall within the what the public should actually do for the citizenry. And just like Celine has said, looking at IPSASB, which is a platform on the IFRS 2, it's an inaugural first standard that IPSASB will be talking about. Although it's going to be effective in January 2028, discussion has gone on for long, since 2026, has been going for it. And it focused on the reporting of public sector related risk and opportunity that affect the environment. And all these will be provided as a GPFR, meaning General Financial Reporting, meaning that the users of a primary user of financial reporting is showing to be part of the sustainability reporting. So, like I said, as you going forward, accountability decision making will be part of the sustainability reporting, just like as we have it in the financial reporting. And the IPSASB tailored this standard based on IFRS 2, which is a IPSASB standard in terms of core content of the discussion. And it's also based on the TCFD, four-leg, criteria of sustainability, but it's going to be effective in January 1st, 2028. So our organizations are preparing. For Nigeria as a country, we have had a regulatory approach to the issue of sustainability reporting, because we know that without regulations, it may be difficult to actually implement sustainability reporting. Fine, standard setter like IPSASB can set a standard, but it is regulator in the jurisdiction. We look at how it can be actually possible in terms of implementation. So Nigeria example, by 2023, as we discussed IPSASB, ISSB, we have a roadmap in Nigeria when we declare our intention to do the early adoption of sustainability reporting for ISSB. We also have in mind to do it holistically, not just in private sector, but in public sector. So Nigeria had a roadmap which is basically showing how sustainability reporting can be shown. But beyond this, there are also issues that have to do with status, regulatory support, which has formed part of resilience that we're talking about in sustainability reporting. Before now, we have MDG, Millennium Development Goals. Now we have SDG, so Sustainable Development Goals, that's going to terminate by 2030. And the federal government and state government in Nigeria asks entity, as a matter of principle in their financial reporting, to explain how they have managed their ESG issue using SDG as a platform. For example, entity can say SDG number 1, no poverty. They are showing their sustainability reporting how they have assisted companies, individuals to maintain the no poverty in their program. The same thing with goal number 4, education for all, and many companies in Nigeria have also supported SDG 4. So similarly, state government and federal government have different programs, including those SDG that have to do with climate resilience. And again, Nigerian Financial Reporting Council of Nigeria had a Nigerian Code of Corporate Governance. Principle 26 precisely speak to management of resilience in terms of climate change. And CBN, NGS, and other people have different principles in managing ESG, and particularly the issue of environment. So what I'm trying to say here is that regulatory institutional should have a kind of program to support the sustainability reporting. It will be easier for entities to do that as we transit to public sector. But the big bang of all this is the Climate Change Act 2021, which is a law in Nigeria that manages the resilience to infrastructure and climate change in terms of requirement from entities to comply with the Climate Change Act. There's a law in Nigeria. There are different environmental laws, but this one is the lead because this one sets national targets. For example, section 19 of the law set a carbon target for Nigeria, which is a climate action plan. And this target cascade from federal, state, local government, and to entities, either private or public. And section 24, subsection 1, asks entities to appoint a climate change officer who will now be managing the resilience in terms of climate change. And the sustainability officer is now in charge responsibility to ensure compliance with the law. And section 24, particularly section 2, made it a fine. It's an infraction or for a private sector that failed to meet their target in terms of target meet for carbon plan. And for MDA, that is Ministry Development and Agency of Government, that failed to meet their carbon emission reduction target, is a matter of a query for the principal officer. Therefore, Nigeria has managed, resilience, climate resilience through regulations, through law, and through proper implementation from different. I think this one is very important for other countries in Africa. Standard alone is good, but there should be other regulatory, aspects. And legal aspect and a statutory aspect to support the standards, for the standard to be very, very effective. In Nigeria, our company are aligning because if they fail to do that, they will not be violating or committing an infraction under the Financial Reporting Council of Nigerian law, but they will also be having issues with other laws like a Climate Change Act, which has been amended in 2023, which basically requires company to show resilience in terms of maintaining climate change action and having somebody responsible for climate change issue, and also to have maintain a culture of sustainable practices that shows resilience and return, having some kind of reporting on sustainability reporting for compliance. So these are the steps Nigeria has taken over the period in terms of declaring our early intention at COP27, where we wanted to, when we adopted IPSASB standard, and we came back to form the Adoption Readiness Working Group, which came up with a roadmap that we are now using now to implement sustainability reporting in Nigeria, not just for private sector, but for public sector. For example, this is the roadmap. We have a roadmap in terms of reporting. We have a roadmap in terms of assurance. In the reporting, we have what we call phase 1. We call it early adopter stage, which is a stage before the effective date of IPSASB standard. That is December 31st, 2023. In Nigeria, we have 4 companies who we refer to as early adopters because they adopted the standard before it became effective in 2020, 1st January 2024. Also, the stage we are now, which is currently running, is the voluntary stage, which runs from 2024 to 2027. And this is at this stage, sustainability reporting is not mandatory now for public interest entity, but it's going to be mandatory on the 3rd phase, which is 2028. For all public interest entities, we have to show the sustainability reporting in terms as a mandatory course. It's going to be part of a general purpose financial report. For public sector, it's going to be 2028 for government and government institutions who are applying IPSAS. So the effective dates aligns with IPSASB timetable and calendar for government and government institutions to start reporting sustainability reporting in line with IPSAS SRS 1 and in line with financial reporting, a roadmap as it is. Now, for assurance, entity has to know one of the beauty of sustainability now is not just about preparing it, it must be assured by a third party to give independent opinion. The sustainability reporting. We are asking the company to do sustainability reporting in the 3rd and 4th year, starting with limited assurance. In the 5th year, they do reasonable assurance. And in the 6th year, they do reasonable assurance without any limitation. These are the platform. All these are contained in the Financial Reporting Council of Nigeria roadmap for sustainability reporting and the assurance timeline. Now, why does it matter for public sector? Why should Account General take it serious? The issue of IPSASB SRS 1 is fiscal sustainability. Move beyond market valuation. Fiscal sustainability is very important. Organization exists for continuity, for going concern. And if resources are not managed in line with Broadland reports and recommendations, then there will be need for company to lack their resources to go around to the citizenry. So it's important we conserve to link our public fiscal accountability to fiscal sustainability. The second one, another thing, is to show public transparency. Now, more than ever before, citizens are asking for transparency and accountability in terms of resource management. The IPSASB SRS 1 display a platform for public transparency in terms of accountability, because now sustainability reporting will be presented as part of general financial reporting, where entity can flip to a particular page and see what has transpired within a year. Budget integration. Entities are expected to link their budget performance to their sustainability resources. And this will now give a kind of services that is linked to the progress and to show the opportunities away from the risk. Public financial management, as we have seen in the post-financial management life cycle, is important to link the resources in terms of income and expenditure and revenue to fulfill and to see how it is consistent to assess capital. Now, for access to finance, many international lenders now want to see sustainability reporting as part of GFFS to see whether organizations have climate change resilient. They want to see whether organization public sector entity has a program for climate change resilience and climate change activities that will support all these are important to financial experts and lenders now. So entities that have green economy practices, and the ESG integration in their practices, and the thematic issue of a corporate governance, environment, social, are likely to access fund with international donors in terms of their sustainability practices. Now, just like we have seen in the IFRS 2 climate-related disclosure, the IPSASB SRS 1 has the same 4 core pillars of sustainability in terms of governance, strategy, risk management, and metrics and targets. In governance, it shows the board, how the board, those who are the top echelon of the organization, are actually accountable in terms of oversight and strategy within public institutions. Strategy cascade down to the management. How have they taken the issue of risk and opportunity in the short, medium, and the long term of the company? And risk management assesses how organizations can set priorities to maintain scenario in terms of mitigating both physical and transitional climate risk that can affect the company. Of course, metric and targets simplifies what are the things that are quantifiable and measurable targets for company to actually show, the entity to show in terms of metric and target, in terms of emissions and other things using emission factor as we have it, either belongs to scope 1, scope 2, scope 3. The total of this gives us a carbon footprint. It tells organization how, and this thing can be, using the different metric and targets as enshrined in the IPSASB SRS 1. And simply we talk about governance in terms of governance, strategy, risk management, metric and targets, and what are the requirements required each of them. Governance asking questions of how and often body is informed about the climate risk opportunity. The strategy is talking about the climate resilience of the entity strategy, in terms of their business model and in terms of planning for scenarios for development uncertainties. Risk management speak to how organizations set their priority, how the entity monitors climate risk, whether and how the entity has changed its process to culminate into risk management, and the input and parameters of entity use. In terms of metric and target, talk about specific target that entity has set for itself, and how this company is managing it. After that, what is company doing? What is it doing now to manage the risk in terms of setting target to reduce the emission? All this is part of what is important. Now, this is for the action that's required for Nigeria for them to be able to actually manage and navigate the issue of sustainability reporting, because reporting comes from sustainable practices. In other words, if you don't have sustainable practices where you can mine that it will be difficult for you to do sustainability reporting. It will lead to greenwashing if you don't have a way. Sustainable practices must be there, and that's what that's culminating to reporting. Otherwise, we'll be doing it wrongly. Organizations must find a way of strengthening their data system to gather their data, and to be able to do this, there must be a lot of education, training, capacity building for entities and employees and across the board to understand the dimensions of sustainability reporting. Then the next thing is to build coordination. There must be a coordination across the board from the different ministry, finance ministry with climate agencies and different, sustainability reporting interest group to be able to do this. Then it will be transformed to policy. So what we have seen in Nigeria now, there are many entities that now have sustainability reporting officers who coordinate all this to ensure that somebody is responsible for data mining, data provision, and is linking to the different strata of the organization. So it's important for action to comply in terms of data strengthening, having a culture of sustainable practices that can lead to data gathering. And this must be built by coordination. Sustainability reporting is not one-man business. It is business that you have to interlink with other departments, other agencies for you to have your, particularly when we talk about scope 3 emission, which is value chain, report from value chain. You must network, you must know what other people are doing. So effective disclosure, therefore, requires more than one reporting. It demands coordination, it demands integrity, and the political will of government, just like what we have been having in Nigeria now. Apart from having sustainability reporting, government is supporting it by law, also by regulation from Financial Reporting Council of Nigeria and other agencies of government. So my advice to Nigeria in this connection, as we are navigating the issue of IPSASB SRS one implementation, I want to challenge you to drive institutional readiness. You must be able to prepare your system, your organization towards compliance, not just by the end of the corner at the 11th hour, but now. The time to start is now. You must prepare your institutional readiness towards sustainability reporting by training, by capacity building, by understanding the navigation of the report. Then integrate disclosures. Yes, there's a need for, if you look at the nature of IPSASB SRS1, the data are actually communicating. Why we report on governance can be a link to understanding the strategy and risk management and also medicine targets. Then inform fiscal risk, ensure climate data directly influence long-term fiscal risk management decision. All this is very, very important in trying to navigate the performance and the sustainability reporting in line with the IPSASB SRS1. And the Akadera has a lead role to play in this by ensuring that there's coordination, because they are going to be responsible for the financial reporting of their entity. And like I said, sustainability reporting is now an integral part of general financial reporting in line with IPSASB SRS1, and it's going to be effective on January 2020, meaning that for 2029 financial reporting, is going to contain sustainability reporting aligning with the IPSASB SRS1. So just like we have had in Nigeria, entity can adopt a phased approach, for different responsibility to be done. And again, we can now build, resilience towards transparency and, to the public sector, credible, accountable, transparent information, and efficient resource allocation in terms of proactive climate-informed budgeting. We don't need to wait until an event happen. Budget can have a kind of anticipating those acute risk, or that can be addressed. Sustain public services resilience through reporting system can actually help government in planning. For example, if your scope where your carbon footprint in 2028 is a particular figure higher, then you can find way to start deploy resources and opportunity and the policy to control it in the years to come. And so the call to action start today, and we don't need to wait to 2028. We need to start to engage stakeholders now. The sustainability reporting are different stakeholders, internal stakeholders, connected and external stakeholders. In champion transparency, we need to start to have people that will champion the sustainability reporting information for the preparation. Preparation is important, and when we begin to plan now, we actually are planning to succeed. So we secure general resilience through the reporting and through monitoring. And once you report for the first time, it becomes incremental in the second. So therefore, the call to action here is to engage the different stakeholders and to champion transparency in terms of networking with stakeholders and secure institutional resilience. In this note, I want to thank you very much on behalf of Dr. Rabi Olowo, the Chief Executive Secretary of Financial Reporting Council of Nigeria. My name is Dr. Abubakar Garba. I thank you for listening. Thank you very much.
Thank you very much, Dr. Abubakar, for that wonderful presentation and lessons shared from Nigeria. Very insightful, and I've loved that Nigeria has already established the roadmap towards adopting sustainability reporting, and more importantly, that the public sector that we're discussing today, by 2028, it's targeted to be onboarded. Important lessons that you've brought, including, yes, the standard is important, but the standard alone is not sufficient. Very key, we must establish laws that are going to support the standard, so that the implementation is backed by law. You brought in several important issues, including having somebody, in your case, you have a sustainability officer who is responsible for the annual compliance reporting. Another takeaway for me, Dr. Razak, is the need to link in sustainability issues to other departments. It's not a standalone item. And that reinforces, again, the issue that Celine brought in on the need to avoid working in silos. And you've prompted us with a call to start today. And delegates that are on the call here, please, the call is that we need to start today, to start engaging stakeholders, identifying who the champions are, and secure institutional resilience. Very important. With that, allow me now to move into questions and answers, a question and a Q&A. We've got a couple of questions already that have been posted on the platform. Kindly, the way we proceed, you could either raise your hand or you could type your question in the Q&A session, then we'll pick it up from there. And I think the first one comes from Lucky, who wants to know the benefits of sustainability reporting. Is sustainability, besides that, you also want to find out if sustainability reporting is based on cash or accrual basis of accounting. Let me bring in Celine.
Hello, yes, thank you for the question. So I'm seeing it too. The benefits of sustainability reporting. I think myself and Dr. Razak have touched on this, and it's really important to think again. There's a number of different benefits, but some of those key benefits are really on building that resilience. This is about reporting, not just for the sake of reporting, but to provide that information for the entity itself and for investors and the different citizens and users who are looking at the reports to be able to enhance and ensure that the entity is resilient and building for the future, to address those climate risks that do have true, real fiscal consequences. I think Dr. Razak also had a great slide. He also talked about building trust with our citizens and users, and providing that transparent information really will enhance the trust that's so critical for the governments. And certainly other benefits like providing investors and with the information to secure the capital needed for a lot of the climate actions that may be needed. And it can also enhance market efficiency and potentially lower borrowing costs for governments as well. And then on the second part of the question, whether sustainable reporting is based on cash or accrual basis of accounting. So certainly from the IPSASB, we always encourage accrual accounting, whether it's with using IPSAS or another standard, but accrual accounting will give you that good financial view, especially when you're looking at longer term information and projecting out how the climate risks affect your assets, your balance sheet. That would look at accrual information. But that said, the sustainability reporting does not require a specific use of a standard or a specific financial reporting framework. So you can adopt SRS1 without a specific financial reporting framework. So you don't need to use IPSAS, for example.
Thank you very much, Celine. Maybe Dr. Razak, from the public sector point of view, and you being on this journey, what are some of the benefits that you can share with the delegates on this call on the sustainability reporting as far as the public sector is concerned?
Okay, thank you very much. I'm happy with this kind of question because we need to know what is in there for you before you do sustainability reporting, and it's good to see it from angle of benefits rather than from angle of compliance. Because if you are complying, you just have to comply. So when you see what you are going to gain, then you now number one, it can save costs for you. It can make to reduce your costs, not just in the medium. Short, medium, but on the long run of organization. For example, if you are able to if you can reduce your emission, you are reducing your energy costs. if you have lower emission, lower scope 1, scope 2, scope 3, it means, scope 1 is those emissions that are linked to your operations, that the combustion or operational related, this. So if you're able to reduce your scope 1, it actually reduces your cost. Scope 2 is about the purchased energy, steaming, cooling you have from, just like what you buy from discos when you buy our kilowatts. So the more you have sustainable practices that can conserve energy, you understand me, you can therefore save your costs through it. So the lower energy that you emit, the lower your cost, energy cost, in your POL. The same thing with cubic of water that you use. If you have good sustainable practices in organization that you control your water system, you use less cubic meters of water than when you are not, all these culminate into what? Into, cost reduction. In terms of risk management, you can use your scenario analysis to plan, how organization can look like in the next 2 3 years. Linking with people, social structure can have you to have less disruptions in organization. Disruption costs money. When organization closes for 2 3 days, it affects your, bottom line. Therefore, what of governance issue? When you develop a culture of the board that is have financial expertise and do the right thing, it's good for the organization. So sustainability reporting is not just about compliance alone. It's about certain benefits. And we talk about capital, access to capital. For some public sector, I know in Africa, including Nigeria, there are some public sector entities that have access funds from World Bank, IMF loan, and other international, financials, because they have certain sustainable practices that can support. Investors now have what we call inclusionary, list of an array of investment that you can go in. And most of it favor sustainable investment, sustainable energy investment. So organizations that develop this can lead to access fund from international lenders, and it makes it easy to save. But internally, you can save your energy. You can have sustainable practices that can make your long-term management to be less expensive, and other benefits in terms of linkages. For example, talk about diversity. Diversity bring about resourcefulness so it has a lot of benefits. So at least it's good to see from angle of benefit, how we can rather than see from compliance. This one will lead to serious benefit. Thank you very much.
Bruce, you are on mute.
My apologies. We've got some more questions. Number one from Godfrey Maseke. Godfrey wants to find out how sustainability IPSASB SRS 1 can accommodate AI, artificial intelligence, I presume, on climate-related disclosures and risk mitigation matters for general purpose financial reporting and national development vision and plan. Celine, would you want to go, or who would want to go, Celine or Doc? Would you want to address that?
Okay, hello,
Sure.
please come. Okay.
Okay, Dr. Sorry, I'll stay on.
No,
You can go ahead. I think.
Salim, Salim can go ahead.
I think this is a very interesting question, and I think there is opportunity likely for use of AI because there could be a lot of data involved in looking at your climate-related disclosures, looking at your risk, and even some if there's capabilities to look at the different scenarios, for example. That said, I think it's very new. I don't know that there's an established or a great benchmark on how it's being used, how AI could be used now. I think it's something that we can certainly explore and would be leveraged by a lot of entities. But until we'll wait and see, I think. And I'm not sure if Dr. Rizak, you've seen this in practice, but I think that's a great point, and it will definitely help with efficiencies and costs of preparing your disclosures and doing some of this analysis.
Thanks. Participants, if you still have a question, kindly type, or you could as well raise your hand, then we'll point at you to raise your question. Doc, there is a very interesting, Dr. Razak, there is a very interesting question that we have, and it goes deep to the service delivery. Marcha wants to find out how to link sustainability reporting from local government and central government. And obviously, you walking that journey in Nigeria, would you share with Marcha on how you can do that?
Okay, thank you very much. Just like I said, there must be linkages in terms of reporting, in terms of value chains. You know, sustainability itself requires you to work with others. At local government level, let's take issue of refuse, management, for example, which is sustainability dimensions. You know, this refuse management pervades local, state, and federal government, and there's been some how entities can actually navigate this in terms of reporting. And by 2028, we're going to have public sectors too, who are already using IPSASB to include the waste management, for example, or issue of emissions, or managing waste dump, which has methane as a part of the GHG emission coming from that side. So all these have some symbiotic relationship or from who cares. For example, if you have a dump site and which generates a lot of emission, or agricultural ranch, so all these has a lot of responsibility. In Nigeria, the custody of land, for example, is in the hand of a state government, who can now give it out to people, and local government are under state government in terms of allocation of land, for example, and there are laws giving responsibility to local governments in terms of management, and also state government and also federal government. So in way, just like we have explained, sustainability has a multidimensional issue, and it cascades to different responsibility and government, be it local, state, and federal government. That's what I can respond on that. But on the issue of AI, I want to add my view on that part of our recommendation, or what we will advise entities that are doing sustainability reporting, is that they can use innovation. They are allowed to use innovation that will bring about fair presentations in terms of their sustainability report. For example, instead of capturing your water manually, your water cubic of meter manually, you can use water metering calculation that give you accurate cubic meter of water that you are used is allowed. You can use innovation sensor system of electricity, whereby when you go into a particular hall, there will be lights. Immediately you leave that hall, then the light goes off. It's the same thing with water. So there are a lot of IT that can be used to improve your sustainability reporting, and the standard is not found on that. But what the France standard wants to be ensured is it fairly presented, is it faithfully representing the information it proposed to represent. So once it's that, then is allowable. For AI, we have not had any experience of anything using AI for now. Thank you very much.
Thank you very much to both of you speakers. We've got a hand. Before I go to the comment section, kindly allow me to bring in Ebenezer Jan. Proceed to ask your question.
All right, thank you very much. I want to ask about we know how even sustainability, how the private sector, I know a lot of them have been struggling. So are we really sure about the deadline about 2028, where we are supposed to actually, all of us are supposed to come on board? And the Association of the Government Accountants, what measures are you putting in place to ensure that are we going to have some level of capacity building in terms of how we will be able to, all of us coming on board, especially just as we want to all be on board in 2028? Thank you very much.
Thank you very much for that question. And possibly, Celine, you can take up that question. And added on to that, there is also another important question related to what Mr. Jayan has asked. The question from Rajiv Isa, he wants to find out whether for governments who are still transitioning from cash basis to full IPSAS accrual, how can they align their roadmap on the adoption and implementation of SRS1 so that they are well aligned by the time it becomes mandatory in 2028? Celine, you can take up those two questions.
Yes, thank you. So the IPSASB set the effective date for January 1st, 2028. So for any periods beginning on or after 2028. We definitely appreciate the challenges with doing sustainability reporting. It is going to be a journey for everyone. That said, this is an international standard, so that effective date is for entities around the world, and that's meant to be, for those every jurisdiction will determine its when it becomes mandatory. If they choose to adopt it, they may take that and set a mandatory date for their jurisdiction, like in Nigeria, where they are looking forward to aligning with that for 2028. So in your jurisdiction, you may choose to adopt it voluntarily in advance, or you may, or it may be mandated, like in Nigeria. And so with that said, thinking around the world, there are definitely entities, stakeholders who told us we need this now. So we wanted to put it out there and make it available and ready for folks as soon as possible. But it will be a journey. Even in the private sector, as you said, there are challenges, and everybody is on a different place in their journey. So it will take a matter of time. And if you're on your already doing IPSAS accrual, or you're doing other accrual reporting, or if you're on cash basis, it is a good opportunity, to, as you build out your reporting framework, to integrate that. As Dr. Razak said, financial reporting will go hand in hand with sustainability reporting. They should be informing each other. And so building those out at the same time and incorporating that will be important to inform your financial reporting. In terms of how you go about that and the capacity building, I think it is a matter of many organizations. IPSASB absolutely wants to do what it can as a standard setter to provide that implementation support, and so we have that sustainability implementation forum. Everyone is welcome to join. It's an open forum to learn more about how we implement the SRS1, and there are certainly partners just like Bruce and AAAG and other partners around the table that are all pushing for sustainability reporting that will be providing capacity building, implementation support, but it needs to be from within your organization to identifying that top down, that support and driving the initiatives. But I think start where you are. Start with assessing your current capabilities. Start with assessing your, identify what do we have climate-related targets? Have we done any assessment? What data do I have? And then look at the standards to start building out, okay, what do I need to do? How do we get there? And identifying where those gaps are that you need capacity building, and then ultimately leading to developing some pilots. I don't think we expect governments to be able to do a full perfect report, and there should be that. I think there's the understanding from investors and users that it will not be perfect, but be transparent. Disclose what you do know, disclose where you're at and what your plans are to get to where you think we need to for disclosures and for your operations and activities. So be transparent and build up to that full disclosure in the longer term.
Thank you very much, Celine. I've got a specific question to Dr. Razak that is addressed to Dr. Razak, but I think allow me to bring in our CEO, Mr. Frederick Riaga. There is a rider to that. Frederick, we just want to get from you in terms of what is IPSASB doing to support member countries around this topic as far as capacity building is concerned?
Thank you, Bruce. IPSASB exists as a platform for sharing knowledge and experiences on various topical issues, this being one of them. Once the standard was produced, we embarked on sensitization, this webinar being one of them. One other thing that we had prioritized, which I saw very well in Dr. Razak's presentation, which was both presentations were very good, is creating a roadmap. And the vastness of Africa, not every country would have the capacity to. So I think we'd then leverage on the network that we've created, the collaboration that we currently have with IPSASB, to generate a model roadmap that can guide smaller African countries in taking on board and adopting this standard. Coupled with the capacity building, we would be happy to support. Beyond that, Nigeria, Tanzania are countries that have gone far ahead in terms of adopting sustainability reporting within their reporting regimes. Peer-to-peer engagements are linking various countries of Africa that are in need of hand-holding with these is yet another thing that, another benefit that platform can extend to the member countries of Africa. Bruce?
Thank you very much, Fred. Dr. Razak, there is a question for you from Alexandra. He wants to find out how many public sector entities in Nigeria are expected to apply IPSASB SRS 1 from 2028. So is the standard being phased in over time, or will all public sector entities be included from year one?
Okay, thank you very much. If you look at our roadmap, the all public sector entity will start by 2028. And we are working with Academia of the Federation for Nigeria to carry along all the public sector entities in that direction. And we have commenced a serious capacity building for public sector entities to understand the IPSASB SRS 1. And you will recall that there are some public sector, we call them commercial public sector entities, that use IFRS. They are already implementing, sustainability reporting in line with IPSASB IFRS S1, S2. But for those ones that are using IPSAS, they are supposed to apply IPSASB SRS 1. And for those ones, we have started training, across the board in Lagos and Abuja to train people. One of the things Financial Reporting Council is leveraging on is capacity building. Because if you don't have this, it's difficult for people to actually produce sustainability reporting that will be complying with the standard. And so far, so good, we have created more than 47 trainings, including webinars and workshop in Abuja and Lagos. Centering on the education on the sustainability. We have worked and collaborated with different organizations like Nigeria Integrated Reporting Committee, ACCA Nigeria, to partner for the advocacy and training towards sustainability reporting. So already we have some commercial public sector entity that use an IFRS. They are government organization, but they use IFRS by nature of their work. They're already applying it. But for the IPSAS entity, we are starting 2028 as in their roadmap, and entities are already prepared, for them to be able to do it. And one of the things we have done in Nigeria, you can't just declare I want to do sustainability reporting. There are what we call readiness tests, where we assess companies to see how ready they are to do sustainability reporting. There are some level of documentation they will submit to us for us to be comfortable that they can go ahead. For example, we want to see that your board supports you for the sustainability reporting, because if your board does not support you, if you have a lot to require, then you must have gap analysis. What you are doing now currently regarding your sustainability and what do you want to do in line with the IPSASB SRS 1, and how do you want to build this gap for you to be able to comply? All these documents are also required. But as of now, Nigeria has more than 6,000 public sector entities. And all of them, we don't know which of them will start exactly, but we are by next year we are going to go massively for training, across the local, state, and the federal government on IPSASB for them to be able to do it. Thank you.
Thank you very much. We still have a couple of questions. This one possibly, Celine, as you were doing a consultation and the like, I would want you to provide to answer to this question from Munyarazi, who wants to find out how well does IPSASB SRS 1 accommodate the unique sustainability priorities of sub-Saharan African countries, such as climate resilience, poverty reduction, food security, informal economic activity, and should the standard allow greater contextual flexibility to reflect these development challenges?
Thank you, Bruce. Thank you for the question. We definitely heard from stakeholders to our consultation that there are a number of sustainability challenges, and there's a number of topics that could be prioritized. What we heard though was still, for our first standard, it's focused on climate. So it's really focused on those climate-related risks and opportunities to the entity. So if you're operating as part of the Ministry of Transport, what are the risks to your infrastructure, to your roads? And so that's the focus of IPSASB SRS 1. That said, look forward to our upcoming projects. So as the policy standard looks at, okay, you may have many different public policies that have climate-related outcomes that affect climate, and so you may also have a mix of policies, and you may have trade-offs when you set policy. For example, you may continue to have a say negative climate impact or outcome, but that's a balance and trade-off because of these other development challenges like food security. You need to still, even if it increases at what your activities are increasing emissions, you still need to continue because of food security issues or whatnot like that. So that is a component we think about in our next project on public policies. And then the broader sustainability challenges and topics we'll look forward to in what may be our next project. So what we heard from our most recent work program consultation was a call for a S1 type disclosure. So that is on general sustainability related risks and opportunities. So that may be coming up in the future. But SRS 1 is focused on the climate-related risks and opportunities to the entity itself. I hope that clarifies the question.
Thank you very much, Celine. Dr. Razak, we've got another question from Dr. Kevin Masawa. He wants to find out how we can institutionalize climate performance auditing so that governments are held accountable, not only for spending climate fund lawfully and regularly, but also for demonstrating tangible improvements in resilience, adaptation, and sustainability outcomes.
Okay, thank you very much. When you look at the nature of sustainability reporting, in terms of metrics and targets, in terms of governance, in terms of strategy, risk management, you see the level of transparency and what the auditors can actually do beyond financials. And the fact that you have responsibility to report sustainability reporting year on year, shows the level of monitoring by, of assurance. Like we have in Nigeria roadmap, after 4 years of consecutive sustainability reporting, you are supposed to have assurance, meaning that an independent, professional will come in to look at your books, whether what you are actually parading in the state reporting is correct. So, and this can be used by auditors or this assurance mechanism is very good to test the water of good reporting in terms of sustainability reporting. For example, your composition of your scope 1, scope 2, scope 3 will be audited by assurance company to see that your GHG emission is actually correct. And the same thing goes in terms of your governance structure for those people that are under your governance. So it cuts across different sustainability dimensions. By the time the assurance enters, it will be obvious where before they can give their opinion, they will be able to get their independent opinion and the audit opinion, and with their verification, be able to pin an opinion. So the idea of assurance in sustainability reporting has taken care of what the question is being asked, because by the time the report comes out, it will show all those areas that the auditor may not want to agree with. And we are starting with limited assurance by entity, and we move to reasonable assurance. And we all know the rigors of assurance in these two levels of assurance, in terms of rigors of work to be done. So the assurance company is part of what we have had in the Nigerian system. It must be assured, meaning just like you are assuring your financial reporting, which can show inadequacy in terms of finance, can even show the evidence of misappropriation. The same thing with your sustainability reporting. The auditor may not want to, sign on because it's not comfortable with a particular. So it's implied that sustainability reporting, when assured, we address all those issues of your concern. Thank you.
Thank you very much. Thank you very much, Doc. We've got another question. From Godfrey. Godfrey wants to find out how we can manage challenges on accessibility and reliability of data in sustainability reporting.
Okay, thank you very much. Okay, am I to answer that, Bruce?
Yes, please, go ahead.
Okay, just like I said, sustainability reporting is not just about scripting information. It's about having sustainable practices that can be developed into reporting. And if you begin to write, it's like you are planning to fail. So the first thing first is to first and foremost develop sustainable practices that could be reported, that can be seen in terms of gathered data gathering in all ramifications of our activities. Let me give you an example of a simple data mining. If you have 10 staff, for example, for scope 3 emission, you want to capture your scope 3 emission, including your employee commuting from one point to the other. Let's say you have 10 staff, and they are moving from point A, from their residence place to the office, and they have to spend either by road 2 kilometers per day. So each of them 2 kilometers multiplied by 10 staff that you have 20 kilometers per day in terms of value chain. Then if they come to office 5 times in a week, that's 2 kilometers now go to 100 kilometers for just for your 10 staff. If they have to work for 52 weeks in the year, that's 5,200 kilometers. And that's what you're going to capture under the employee commuting for the for that year. Of course, you are just where an employee should not maybe it's absent. So these are how you begin to gather data for that particular sustainability dimension. You go to another sustainability dimension, cubic meters of water that I've used. How many days? I've just said that it's possible you have a meter that will be responsible for that in terms of calculating the accuracy. So the first thing first, in terms of how many liters of fuel have we used from our operations that is directly linked to our operations, All those data can be obtained from admin, procurement, or including suppliers. When you travel, employee commuting either by air or on the road, all those information is something that can be gathered not just at the end point, but on daily basis as they occur. And that is what you cascade to your sustainability reporting in terms of metrics and targets. So it's not a figure that you have to provide at the end of the year or you congestion. These are the things, there must be a data mining system. Somebody must be able to keep this record. And the sustainability officer is not a solo work, like Celine said. You have to link with other practitioners and stakeholders. For example, the issue coming from value chain, you come from procurement, you may have some data coming from your human capital or human resource, as the case may be. Some will come from your head of driver in terms of the mileage of vehicle and this one. So you must first and foremost be familiar with all these sustainability dimensions in terms of environment, social and governance strata for you to begin to get data. So therefore, this is area, for example, what management is doing in terms of meetings, who are the people that are heading, how many times. So all this is something that can speak to data gathering. So I encourage organizations and entities to start data, to understand how they can actually gather data for them to report. It is when you have this data that you can now combine to your carbon footprint, which you now take the decision to reduce, moving to net zero. So without all this to be difficult to do. Thank you very much.
Thank you very much. And as we head towards the end of this conversation, a couple of questions have come through. And, when you're having a good conversation, you don't realize how time flies. But allow me to bring you in for the last time. Celine, you answered the question from Valentine Bunoge, who is asking how can public information be incorporated into, how can public debt information be incorporated into sustainability reporting within financial statements to enhance transparency and accountability? As you answer that question, Celine, you also give your final conclusions. Then Dr. Razak, you answer the question from who wants to find out what should be the top 5 actions a government should take ahead of early adoption and application of IPSASB SRS 1. Celine, you can go ahead.
Yes, thank you. Thank you, Bruce. So to Valentine's question on public debt information. So if you have financial reporting on accrual basis, then certainly your liabilities are on your balance sheet, and that is a key information that also links to your sustainability reporting. So as we think about climate resilience and your climate risks and opportunities, that will drive you certain potential increase or decrease in your liabilities. You may have you may be looking at your climate related risk and looking out and forecasting into the future, short, medium, long term, about the investments that will be needed or the expenses that may be incurred for disaster recovery or for new investment opportunity. And so that can inform your public debt and your liability forecast, or the need for investment and capital. And so that is the two are linked very closely. And so the sustainability information and the reporting, the assessments and analysis that you do should inform that financial reporting and your financial statements. So with that, I want to again thank you all for your time and for the opportunity to share about the IPSASB SRS as we've discussed really, and I think has been emphasized to get started early. Look at the standards. The standards are a starting point. It's just to give you a starting point at what information would be useful for the entity itself to drive resilience and also to provide users with that important information to drive their decision making and accountability. So I encourage you certainly to use the standard to get started, to look at the baseline and start to do that gap assessment, readiness assessment, and if, as you're interested, certainly reach out to join us on our Sustainability Implementation Forum to learn more and continue to learn from other peers who are advanced in this. So thank you very much.
Thank you, Celine. Dr. Razak?
Okay, thank you very much. Thank you. 5, advice or tips for implementing entities. The first one, you have to have your clear objective to implement. You must be able to have your mind that, okay, I want to, so that you can start early. Just like Celine just said now, you have to start early because you have this early movers advantage when you start early. Just like Nigeria now, the early adopters are really leaders in terms of experience, and the voluntary adopters are actually learning from them. And the same thing, those people that will apply and adopt when it becomes mandatory. So I advise you to start very early. The other one is capacity building. Try and develop capacity building towards sustainability reporting. You have to learn new things and unlearn certain things that you had before and relearn, as the case may be. It's a lifelong journey of learning. So you need to develop a mindset to be open to information and to new knowledge that's coming in. And that's the best way to do it. Then you need to engage stakeholders that are within the organizations and others that may have to networking. And this is a good advice in terms. Then other ones, you must be able to develop advocacies and training platform, not just for your different organizations. Like, for example, Financial Bank of Nigeria is having good relationship with different organizations, including IPSASB and IPSASB, and NRC, the Institute of Chartered Accountants of Nigeria, the ACCA Nigeria. We have a collaboration so that we can understand the different dimensions and to build that capacity building. So I encourage you to have that advocacy, mentality to network with different kind of stakeholder groups, not just entities that are preparing, but for those people that are also education. You be with them. When they make mistake, you correct them so that they be able to do it rightly. And the beauty of IPSASB standard is there's a mechanism called proportionality mechanism, where entities are allowed to bring information as they have it, while they are looking for other information without undue cost and stress. Therefore, entities should be allowed to try their best, but we should undo them, correct them when they make mistake, and is something that, just like Seni said, you can get information that you have to do. Don't do greenwashing, but just get information as accurately as possible. In this connection, I think sustainability can be done rightly. Thank you very much.
Thank you very much, Dr. Razak and Celine, for your insightful and wonderful presentation, very thought-provoking, and also to the delegates for making this session very engaging. For us at IPSASB, this conversation reminds us that climate change is no longer only an environmental matter. It is now a public finance, governance, and accountability issue. Climate risks are already affecting our infrastructure, service delivery, migration pressures, insurance cost, and fiscal balance, and long-term sustainability on government services. We've also picked that IPSASB SRS 1 marks a major shift in public sector reporting. It has introduced a global framework for public sector climate-related disclosures, and governments moving governments from fragmented climate information to structured, comparable, and useful decision-making reporting. The standard is not simply about producing another report. It is a real value. Its real value lies in helping governments understand how climate-related risk and opportunities affect our budgets, our assets, our public services, fiscal risk, and long-term planning. Ladies and gentlemen, from us as IPSASB, IPSASB SRS 1 is not only a reporting standard, it is a resilience tool. It gives us and our governments a framework to disclose climate-related risks transparently, better plan, protect our public asset, support accountability, and prepare for physical realities for climate change. We want to thank you for being with us, for the insight shared. We recognize all that have attended, the ages that are around. We thank you very much, and we come to the close of this webinar, but just a couple of announcements. We will send the presentation to your emails that you registered with us. We'll also send the certificates. Ladies and gentlemen, it has been a wonderful conversation, and we hope to meet you on the 31st of July for yet another excitement webinar. Have a lovely day, and good evening, good afternoon, good morning from wherever you are joined us from. Bye-bye from us.
Bye-bye, Helen. Bye-bye. Thank you very much.